Welcome to Fisher Webinars. The following is a recording of how does China's containerboard market compare to the US, originally recorded on Thursday, June 2nd, 2016.
So today's topic is evaluating the Chinese and U.S. containerboard markets. And of course, given the 30-minute time slot today, we couldn't possibly completely do a detailed look at every aspect of the markets. And so what we'll do today is what you might think of as a quick look or a mini diagnostic on some key factors within each market. And hopefully what we'll try to do is demonstrate how through good use of facts and data we can develop some insights and answer the question, so what? So what does it mean for each marketplace given the structure that we find during our analysis? And that's important because oftentimes executives who are running businesses and those who are observing industries, you can only see the performance, either the performance of producing mills, performance of suppliers in the industry, but we know that performance is a result of behavior, that is the choices that individuals make in a given industry. And oftentimes that behavior sometimes might seem unusual or different than we'd expect, but upon further examination, if we understand the structure of the industry that we're analyzing, we can often find that the actions that participants take and therefore the performance is entirely predictable because of the structure of the industry. And today what we'll try to do is analyze the structure of Chinese containerboard and compare it with the US and think about what that means in terms of how the containerboard market might evolve in China. And the first chart we'd like to start with, just to level set the talk, is a graph that shows total production of containerboard for each producing country. This is from the Fisher-Solve database. And we can see clearly that China and the US are 1 and 2 respectively. These are big markets, and we've done this analysis as what's called a Pareto graph, or some of you might be familiar with the 80-20 rule, where the orange line shows the cumulative total production by each country. And so the way you read that is China and the U.S. containerboard markets account for 50% of the world's total production of containerboard. So another way to say that is these two countries, the U.S. and China, make as much production of containerboard as the rest of the world combined. And so, obviously, the implication is that what happens in both of these markets is extremely meaningful and important to the overall containerboard industry and worth understanding. In terms of the growth rates of the two marketplaces, China and the U.S., what I'm showing you here is a screenshot from Fisher-Solve. And I did this for one reason. Throughout the rest of the presentation, you'll see analysis, mostly in charts, that we've derived by exporting data and analysis from Fisher-Solve. This particular screenshot shows you that you can in fact do most all of this analysis within the tool itself if you chose to. This is from our capacity trend module in Fisher-Solve. It shows changes in capacity, both historical and announced, over multiple time periods and over multiple combinations of the data in Fisher-Solve. What I'm showing you today is the trend of containerboard capacity in China, which is the green bar, and the US, which is the red bar. And there's a pretty clear story here. What you can see immediately from the chart is China has experienced quite impressive and rapid growth, whereas the US, as one might expect, as a more developed marketplace, has been relatively flat. Chinese compound annual growth rates over this time period have averaged about 10%, whereas the US is just under 1%. So if we take the data and smooth out some of the lumpiness in that that total capacity number, we can start finding, I think, some interesting takeaways within the data. So what I've done here is smoothed Chinese total containerboard capacity. That's the purple line, and you can see it is a bit bumpy. Some of that's caused by timing of projects. Obviously, I've smoothed that out. That's the orange line. And then what we're going to do is evaluate the derivative of that line, that total capacity number. So what we're thinking about now is how is the growth in capacity in China changing? But we're going to even go one step deeper into this analysis to find something interesting. So what we've done is now charted that change in total Chinese capacity. So this is the first derivative for those who are familiar with math. If we draw another line in this trend, what we can see clearly, and this is what you might refer to as the second derivative, or the rate of change of capacity change. So another way to think about this is this is telling us something about the momentum of change in the marketplace. Is the growth rate growing faster, or is the growth rate slowing? And this could be, again, a good indicator of momentum and where the marketplace is headed. And we can clearly see in the early 2000s through 2011, of course, there was a Great Recession in the middle there, but overall, we see two different periods of increasing growth rates in capacity change, so a market that had a lot of momentum for growth, and what I think most importantly, what we see since 2012 is a decline in the growth rate of capacity in China, a very clear trend that the growth rate is slowing. And what this almost certainly means is this has created a situation of surplus capacity in China. So the dramatic growth rates in Chinese containerboard that we saw 4 or 5 years ago almost certainly created capacity surplus in the country, and so therefore we would expect to see low operating rates in China. And in fact, that's exactly what we find. So this chart shows operating rate, that is the apparent demand divided by the containerboard capacity. And what we can see from the chart is that Chinese operating rates were okay. They were in the high 80% range in 2008 and 2009. And starting in about 2011, 2012, when all of this tremendous capacity growth occurred, we see a fall in the operating rate. Now, of course, this is, although the global economy hasn't recovered as quickly as folks thought it would coming out of the Great Recession, it certainly hasn't. Certainly, the Great Recession didn't extend through 2013, and so what we can draw from this is mostly a function, this low operating rate is mostly a function of overcapacity or capacity surplus rather than demand, though certainly slowing overall global demand over the last year or two hasn't helped things. The takeaway here is that Chinese containerboard market essentially overbuilt to demand that we've seen, and that's resulted in very low operating rates, particularly compared with the U.S., which has averaged in the mid-90 percentages since 2010. In terms of how quickly the two largest containerboard markets evolved, on this chart we have a total of containerboard machine capacity by year built. The dark green bars is the United States, the light yellow bars China, and as we can immediately see, the U.S., whereas the U.S. took, call it 50 to 60 years to evolve, the Chinese containerboard market was essentially built in the last 25 years or so. So a very, very young market, very new market, very rapid growth. So just how rapid of growth are we talking about? I thought this was an interesting analysis, something you might be able to use in conversations with your colleagues going forward. So one way you might think of how quickly and how rapid Chinese growth has been is to compare one mill in China, a very large mill, this is Nine Dragons Dongguan Mill, with the entire U.S. containerboard market. So there were more containerboard machines built in Dongguan, twice as much in fact, after the year 2000 than was built in the entire United States over that same time period. So again, one mill in China, Dongguan, more containerboard machines since 2000, twice as much in fact as in the entire United States. So very rapid growth, very rapid investment. And what this has generated, as you would expect, this rapid growth is very different result in terms of the fragmentation of the marketplace and market share. So this is a chart that shows company shares of production for China and the United States. You can immediately see that the U.S. is much more consolidated, where essentially you have four large players that account for most or the lion's share of the capacity in the marketplace, whereas in China, outside of Nine Dragons and Lianman, the two largest producers, you have very fragmented marketplace, lots of companies, and in fact you have about 191 containerboard companies in China, whereas 29 in the U.S. And so certainly from a perspective of the volatility we'd expect in the marketplace, the behavior of participants that we'd expect in the marketplace is going to be quite different because of this fragmentation. It also, of course, impacts how suppliers to the industry might approach both segments. So whereas, for example, you could have a few strategic corporate accounts individuals call on most of the capacity in the United States, it's 3 or 4 companies. Obviously in China it's going to require much different resourcing to cover 191 different companies throughout the country. So this is a pie chart that shows that bar of Chinese company share a little bit in more detail, and so we can see Nine Dragons and Lianman have 30% of total marketplace capacity. Anhui Shanying has 5%, and then after that it really drops off into what you might call the 2s, 3s, and 1s, very fragmented. And we can actually see that from this chart that almost half of the marketplace is made up with companies with less than 1% share of the marketplace. And as we mentioned before, we'd expect that this amount of fragmentation would contribute to more volatility in the market than you would see, say, in the U.S. We'll take a quick look at how the two markets' production differs in finished products and also their channel dynamics. So let's start with the U.S. So this pie chart shows share of total production in the U.S. by finished product. We can see from the chart it's 50% kraft liner, so this is virgin kraft liner, followed by recycled corrugating medium, and then some of then white top liner and recycled liner. This production is going into a marketplace that's predominantly forward integrated box plants. So this purple box represents the percent of total U.S. containerboard shipments that goes into goes to box plants owned by containerboard companies. So, for example, IP, WestRock, Georgia Pacific, PCA, etc., own their own box plants in front of the mill, and they transfer or sell paper to their own box plants. And as you can see, that's a very large portion of the marketplace, around 70% or so. The next two boxes, the orange box is non-integrated box plants. In the U.S., sometimes this is referred to as independent box plants. So these are open market sales of container boards to box plants not owned by U.S. Producing mills. And then the blue box is export. There's a fairly significant amount of volume exported out of the United States, primarily kraft linerboard. in fact, it's nearly all virgin kraft linerboard, and as we can see, that's a large share of total production of the U.S. So let's take a look at how this is different in China. So we've got the same pie chart, and as we can see, immediately the U.S. or Chinese share of production is much more skewed to recycled linerboard and mediums than it is in the U.S. And in fact, nearly all of the containerboard produced in China is based on recycled, really old corrugated containers. And that's going into a different looking channels as well. In fact, starkly different from the United States. So remember, whereas the for the U.S., the non-integrated channel was a much smaller portion of the total volume, in China, so it's nearly reversed, where we find that most companies, most containerboard companies in China are not forward integrated. In fact, it's probably below 20%. Forward integration, so they're selling to a almost completely selling to an open independent market of box plants. Very low integration levels in China. The second thing I want to point out is the blue bar, which is nearly impossible to see for the Chinese channel map. There is essentially zero exports of containerboard out of China. And so the implication of this, the importance of this is, whereas you can think of the U.S., if you're a U.S. producer, you have several levers you can pull if you're in the goal of optimizing your production and managing market dynamics and volatility. In China, on the other hand, you're really just relying on the domestic non-integrated marketplace for your volume. So we'd also expect this to contribute to volatility, because to the extent demand would change, or you'd have capacity surplus in China, there isn't those different channels to move volume around like there is in the U.S. And as we saw in the pie charts, the large, almost entire proportion of Chinese containerboard capacity is recycled. And let's think about whether or not you might expect to see that export channel grow out of China. This chart shows OCC gathered in various regions, Europe, North America, and China, and then production or consumption of OCC. And the quick takeaway is that China imports nearly all of its OCC from North America and Europe. And so again, if we recall back to the previous slide that showed all of the production in China is OCC, or recycled base, it's not logical that Chinese producers would be able to import OCC, say from the US or Europe, run that OCC through a containerboard machine, spend the energy to dry it and the labor to make the stuff, and then only to ship it back from where it came. So we can do a simple thought experiment to conclude that a growing export channel within China is probably not going to happen, at least in the short run. And extending this thinking about the different channels that Chinese containerboard companies have and the lack of options, we can see this again in the operating rate. So as the Chinese market built capacity and relying on that domestic, having to rely on that domestic demand without other outlets to push production, we see the result again is in this very low operating rate. Now, an implication of low operating rates, particularly the types of numbers we see out of China, which is currently around 80% operating rate, we'd expect the price to be on the floor. Yeah, we'll describe what the floor price is in a few charts. And if we look at a trend of prices out of China, particularly for fluting and test lining, this is a chart presented by a Chinese paper distribution company. We can see a couple of things interesting. One is prices of Chinese containerboard, that's the dark gray and light gray lines, were bumpy or volatile up until 2013 or so, and then have been flat. And we'll show you why it's been flat in a moment. But let's look at the price. It's around 3,000 yuan per metric ton. If we look at a cost curve, we can understand in a little bit more clearly exactly why that price is where it is at the 3,000 number and why it's been so flat. So this is a cost curve showing total capacity in China. Remember, we estimate the operating rates around 80%. So if we find a spot on the curve about the 80% level, this is what the first orange arrow is demonstrating, we can find an equivalent cost of production. And when we do that, we shouldn't be surprised to find that, again, we're at the 3,000 yuan number, which is exactly the price in China. And so as we'd expect from the structure of the industry, this overcapacity has caused prices to fall to what we use in Fisher terminology, the floor. And the floor price is a point at which is really set by the higher cost producers at the level of operating rate within a given marketplace. And you usually see this phenomenon when you have a situation of very low or low operating rates. We see the price fall to the floor. That's the point at which producers can't sell any more tons of product and make a profit, and so the price tends to be sticky at that point. And in fact, we can see that if I unwind this, we can see that exact same stickiness in the pricing chart, where prices have fallen to a floor. It even looks like a floor in this chart, and really for 2 years. Okay, so because China relies so much on imported OCC primarily, we can see that their costs on average are higher than the U.S., which is the green bars China and the red bars U.S. If we just take a look at the averages for each country, we can clearly see the drivers of those differences in costs. Green is fiber here, so we can see that Chinese fiber costs are on average $30 or so higher in the U.S., and logically this is, of course, because you're collecting this material, this OCC material in U.S. or Europe, and then having to ship all the way to China. And because of the usage of recycled, high usage of recycled in China, we also see a equivalent increase in chemical costs. This is things like starch and strength aids and additives when you're running a high recycled machine. If we split that cost curve that we saw earlier into two groups, the Chinese containerboard mills on the left, U.S. containerboard mills on the right, we can see that these slopes are different. So each of these numbers shows the average change in cost per mill. So the way you think about this is the next highest mill in the U.S. is on average $1.70 per metric ton, higher cost than the one before it. China is about 60 cents. So what's interesting to note is the takeaway is that in the being low cost, for one, in China doesn't create as much differentiation as it does in the U.S. But two, because there's more of a cost difference or more of a margin difference to be made with lower costs in the U.S., particularly on over volume, we'd expect to see incentive for more rebuilds, more projects to debottleneck machines in the U.S. than we do in China. And I think that's also reinforced with this chart. This chart shows for each containerboard machine in both the U.S. and China. The U.S. is the light green, China is the dark green. We can see a couple of trends immediately. One is that the U.S. machines' technical age, which is the y-axis, much older than China. And so if we think about the two marketplaces, you've got a situation in the U.S. where you've much older technology, a steeper cost curve, meaning there's a larger benefit for incremental volume production. We should expect to see more rebuilds in the U.S. Going forward than we would in China. Another aspect of the two marketplaces which is quite different is labor dynamics. So this chart shows the average price of labor on the x-axis versus what we call the usage on the y-axis. This is a total number or total average total employees on a given containerboard site. So in China we can see that around 425 average employees on a given mill site, whereas in the U.S. you have 250. You can also see the productivity is much higher in the U.S., nearly three times as much as it is in China in terms of metric tons per year per person. And clearly, you know, obviously, what we can see from this graph is that higher wage rates in the U.S., nearly 4 times as high, $40 per hour, creates a larger incentive to run leaner in the U.S. Than it does in China. What's interesting is if we take a dive again into Chinese containerboard costs, even though we have a situation with low labor rates or low wages, I should say, there's still a large difference between what I'm going to call here the indirect costs, or you might think of it as the fixed cost per ton for Chinese mills. So this chart just shows Chinese containerboard capacity. This is a build-up from Fisher-Solve's cost curve benchmarking tool, where we've removed all of the direct costs. So these are fiber and chemicals, things that you need to buy every time you make another ton. So we're now looking at cost components that you might think of more as fixed. When we look at this, we can see there's quite a gap from the highest cost producers in terms of fixed costs with those that are low cost. And so we can think of it as ironically, even though we've seen there's lots of capacity in China, lots of new machines being built, and you might say, well, is there going to be more greenfields? Interestingly enough, it appears that building large-scale machines could still pay in China. And actually what's interesting is as that compares to the U.S., Chinese producers get a better return on new greenfield investments than they do in the U.S. So this chart is just simple math. We've taken the average cost of a greenfield mill in dollars per annual ton of capacity, and we've divided it by that spread, by that difference between the highest cost and lowest cost producers, both for the U.S. and China. And so what this tells you is if, to the extent you build a brand new, very large, very efficient, high capacity greenfield mill in China, it gives you a better payback than it does in the U.S. because there's such a difference in fixed costs among participants in China. And so what's interestingly is even though we see operating rates about 80% today, you might in fact see new capacity coming online in China. And in fact, when we look at data from Fisher-Solve showing announced capacity in China, we can see just that's true. So this is China and the U.S., green bars and red bars respectively. And despite low-ish operating rates in China, we still see through the next 2 years 11 million tons of capacity announced. Now, of course, some of these projects won't come to fruition. They'll be postponed or something will happen, but clearly we can see still a drive to add capacity in China. And despite the analysis we showed earlier, which is this dramatic slowdown in the rate of capacity, I think what we should remember, this is still a cyclical industry, right? So this chart shows capacity change for both China and the U.S. Again, China is still the green bars, and as you can see, although there's changes in the rate of capacity growth, we can also clearly see cycles in the industry, and the data from Fisher-Solve showing announced projects clearly, I think, continues that trend that this is an industry that moves in cycles. So what's astonishing is despite what you might think having a mindset from, a different kind of mindset that, why in the world would you add more capacity to a marketplace that has 80% operating rate? It appears that just that is happening. And if we look at those machines that are under construction versus those are operating, we start to prove the point which we made earlier, which is that it still pays, if you will, or Chinese producers still incentivized to put in scale machines. And so this chart shows the average trim width of operating containerboard machines in China versus those under construction. As we can see, those under construction are 20 to 40% wider than they are in for operating machines. And this is probably a smart strategy. This chart shows Chinese wage growth. As you can see, it's been phenomenal. The growth has been quite rapid, essentially tripling annual wages over the last year or so. And so what is this going to do to Chinese containerboard producers, how it might change the market dynamics? So what we've done on the next chart is done a scenario within FisherSolve, a what if analysis changing the labor rate. The green bar is the base case, so that's today's cost curve, and then we've pushed those costs up by changing labor rates. And what you can see is that obviously, as you think, those machines that have lower productivity, lower scale, a change in the price of labor is a much larger lever than it is for the largest machines. And so we'd expect a bit of an asymmetry here. As wages increase in China, more pressure on higher cost, smaller, lower productive machines than large machines. And of course, if you're a producer and you have an expectation of higher wage rates going forward, this is also something that might incentivize you to add even more capacity into the marketplace because you have to. Today, if we look at the three largest producers, Li and Man, Nine Dragons, and Hui Shanning, we can see that they're already fairly low cost. This is total average cost by company. And so let's segue from this chart showing total average cost per company to thinking about M&A. So the first point I would make is that we talked about how we've spoken about how fragmented the Chinese marketplace is, and if you're the three largest producers, it's not likely you're going to buy a lot of your higher cost competitors just for the sake of consolidation. So let's think about what happens as new capacity enters the marketplace and if that might consolidate the market in itself. As we showed earlier, there should be an incentive still for new capacity to enter the Chinese marketplace. As that does, it's almost certainly going to be lower cost. You never purposefully add a higher cost machine to a marketplace. So you'll expect those machines to come in the first, second quartile. As that happens, it will pressure higher cost producers and eventually push them out. And to the extent that those machines come in through players that are already big today, we can imagine how this consolidates the marketplace. And in fact, we can see from this chart, the wider bars show us that to a certain extent, that's exactly what's happening. The more of the fragmentation, more of the smaller machines exists in the upper third or the third and fourth quartiles of the cost curve. So as we see this industry continue to evolve, I'd expect to see some consolidation just through what you might think of as shakeout, that is higher cost machines coming out of the marketplace, and the survivors that are left are bigger, and they get bigger and bigger, and they leverage additional fixed costs, and they get bigger still. And so we should expect that as more of a mechanism for consolidation moving forward than M&A, at least for the largest producers. As that happens, we talked about the price before. You would expect to see the floor price actually fall, right? So as higher cost producers are pushed out of a marketplace, so long as the price remains on the floor, you'd expect to see a new floor price which is lower yet. And of course, this would serve to provide even more pressure on the higher cost producers, pressuring them to remove capacity, but also perhaps and potentially result in lower margins for the remaining players. So to summarize, should we expect to see M&A at least from the biggest players in China? Probably not. From Nine Dragons and Lee and Man, they're already quite large. But again, why in the main? Why would you go around and buy smaller, mostly higher cost capacity? And in fact, because there's so many of those small players, 1-2%, you'd have to acquire many of them to consolidate the marketplace. That's not to say we're not going to see any M&A in China. There has been M&A, and so you'd expect, whereas we're making the case you might not see it with the largest players, you probably could see it with the smaller and mid-tier size companies merge in the marketplace. And in fact, we've seen a little bit of that. I thought this was interesting. This is from a few months ago. This is an announcement of 7 board mills merging in China, which a seven player merger is something you don't often see in the U.S. So again, you might expect this kind of activity amongst smaller participants. As we tie this talk up and wrap it up, let's just summarize. We're going to come back to the chart I showed at the beginning, which is, again, in the 30 minutes or so we've had here, impossible and would be an exaggeration to say you're going to walk away with everything you need to know about containerboard in China and the U.S., but we can start to scratch the surface and think about, what's different about the two marketplaces and what does that mean in terms of implications. So, for example, if we look at the company shares, we found that China is much more fragmented than the U.S. We would certainly expect something to do, that some impact on the cycles that you should expect to see in China. We saw a little bit of that in operating rates. If you're a supplier to the industry, I think it also should inform how you think about going to the market. So in the U.S., for example, you can, if you find the right individual or group of individuals in a given corporation, you can call on 5 of them and essentially have FaceTime with the majority of the market. Well, in China, it's 191 different companies, so much different time and territory management strategy, sales cycles, etc. But lastly, let's look at technology as an example. As you're reading, as I'll let you read the other points, much newer in China, much older in the U.S., but we showed how you shouldn't be surprised to see additional rebuilds in the U.S., and I think many would actually argue that the U.S. Containerboard, or actually paper industry as a whole, has been somewhat underfunded in the last 5 to 10 years, so you should expect to see more investments, debottlenecking investments to get more productivity out of U.S. machines. And what's interesting is, despite the fact that Chinese fleet is so new and the whole industry is so new, whereas you might not see as many rebuilds in China, or machine rebuilds, you should expect to continue to see more scale machines, because as we showed, there's still a big enough differential between the fixed costs of highest cost producers and low cost producers to probably make that a good economic choice in some circumstances. And of course, like we said, there's so much more we could analyze on this topic. We'd need to take days, if not weeks, to do it to do complete justice. But that's as we end the talk, and for many of you on the call who are our customers, that's why we've tried to collect really what's an ocean of data and push it into a tool that you can analyze many different ways and answer questions that might be important to you, so that you can understand the underlying structure of a marketplace, and therefore think about the strategic choices and levers you're going to pull to make you successful.